Hi there folks, it's James Marlake here, co-founder at Livewire Markets, and we've got something special for you today. I'm joined by Patel, who is the CEO of Blackstone's Private Equity Strategies Fund, and we're going to be talking all things private equity, what's going on with deals, some of the themes, and where Blackstone is seeing opportunities. Viral, thanks for coming to Sydney, great to catch up.
Thank you so much for having me.
Let's start with the deal environment. Your President and Chief Operating Officer, John Gray, talked about deal making reaching escape velocity. What does that mean, and what are you seeing on the deal side?
It's interesting when we think about what's happening in the market right now. There's a lot of headlines about noise and volatility and risk. In terms of what we're actually seeing on the ground is that, similar to what John said, the deal activity is increasing pretty materially, and it's being driven by a few different factors, right? We have a macroeconomic backdrop which is actually quite resilient, particularly in the United States. You've got companies and earnings that are quite strong. You're seeing inflation in a pretty good spot, and you're seeing cost of capital across the system come down as monetary policy drives Fed base rates down and spreads are collapsing. So if you think about what that means, if you've got strong operating earnings in companies, if you've got inflation under control, and you have cost of capital going down, those are environments where investors want to put capital to work, right? And that's what you're actually seeing in the market right now. So deal activity is up materially year over year. So in 2025, it was actually up about 36% over the prior year. And the other thing that we're seeing is scaled private equity is actually where you're seeing the most amount of activity. So larger companies, ones that can withstand the volatility and the choppiness in the marketplace, can push pricing through to withstand tariffs and redo their supply chains and work on AI initiatives to enable their businesses. Those are the sorts of companies where you're seeing activity increase the most.
That's a bit of a high-level overview on deal making. Let's maybe go down a level to some of the themes, some of the areas that are of particular interest that you think investors should pay attention to and that Blackstone's paying attention to.
We at Blackstone are quite thematic in the way we approach the market. And one of the things that we've done pretty well, actually, relative to many in the market, is every time we've launched a new business at Blackstone, we've tried to think about how is this going to enhance the network effect of the overall business. So we manage over $1.2 trillion of assets at Blackstone across a variety of different strategies. And each quarter, we bring everyone together to talk about what is the data and the signal that we're seeing coming out of those companies. What are the parts of the global economy that are accelerating? Where do we see deceleration? How do we want to position our portfolios? And that exercise, again, we do this every quarter, is what drives our ability to kind of figure out where we want themes to go. And our network is quite big. 270 portfolio companies, 13,000 pieces of real estate. We lend to over 4,000 borrowers. So that gives us a very, very good sense of what's going on from a true data perspective versus kind of what one might read in the headlines. And today, when we look across that landscape, we're putting capital to work in a few different areas. One, we're very focused on investing up and down the AI value chain, right? So we have capital that we're putting to work in the energy complex to power AI. We're investing in companies that are part of the digital infrastructure to enable AI. And then we're also investing even into the application sector, right? So applications like OpenAI, Anthropic. So everything up and down that AI value chain is something that we think is a very, very attractive place to continue to put capital to work. Secondly, we're very big believers in franchisor business models. If you look at some of our larger investments that we've made over the last few years, companies like Jersey Mike's Sandwiches, Seven Brew Coffee in the United States, these are franchise business models where if you find the right concept, you can be tremendously high growth, high margin, high free cash flow, right? Because the right concept means you can open store counts, but the franchisee is the one opening the actual stores. So as a percentage of royalties and system sales, very high growth. So those business models are ones that through decades really have been attractive places to put capital to work. You can go back to 2007 when we invested in Hilton, another franchise model. And so that's a business model that we think is durable and one that we're going to continue to put capital behind. And then one other one I would tell you is, we're really focused in today's world on looking at things that are part of the physical economy, right? If you look at what's been happening in markets for the past 3-4 weeks, there's been no shortage of AI fears in the market. Different sectors have had multiples re-rate. And we have always been a very diversified investor, and the physical economy investments, things that are not as exposed to that disruption, continue to be attractive places to put capital to work.
Some examples on the physical side. Here in Australia, we're very familiar with mining businesses, copper, commodities. What do those assets look like for you? What sort of business are you looking
Yeah,
at?
I mean, we tend to spend maybe a little bit less time on the commodity side of the market. We tend to be a little bit more of a service-oriented type business. But one area that you can spend a lot of time thinking about, and we're doing this on the private equity side and also even on our real estate side, is travel and leisure continues to be something that has good tailwinds associated with it. Particularly coming out of COVID, 5-6 years ago, all of us as of a society have really pushed externally, and consumer spend continues to move into experiences and wanting to have experiences. And so we'll make investments in music publishing businesses, as an example, where we can benefit from just the increased consumption of music that is happening globally. We have investments in theater companies, as an example. Things like our restaurant businesses where people are going out. Those are all parts of what we viewed as being the physical economy. And then yes, the industrial complex can certainly be an attractive place to put money to work. Aerospace and defense right now is in a very good part of the cycle that we think is an attractive place to invest behind.
Yeah, it's interesting, out of all of those themes you've talked about, a lot of them are business models that have been around a really long time.
Absolutely.
People touch, franchise, a cup of coffee. But let's talk about the big headline one at the moment, AI. Huge deals being cut.
Yeah.
Enormous amounts of capital being raised. Lots of opportunity, but also a lot of uncertainty about, there's a bubble headline every day. How do you view the space with all the capital flowing into it and all the interest? Do you buy into the bubble fears, or how do you think about it?
We spend a lot of time today discussing this concept of, is there a bubble? Is this going to pop? Where is that going? However, I feel like we don't spend enough time thinking about the parts of the economy and the parts of everyone's portfolios that are potentially subject to risk of disruption. And we certainly started to see that in the past few weeks. Software multiples re-rating, insurance brokerage re-rating, financial services re-rating. And one can debate whether that's been an overreaction or not. But I think it does highlight the fact that AI is one of these changes, secular changes in our society and our economy that is going to ripple through significant parts of our businesses. And so we should be talking about the bubble fears and the valuation fears, but we should also be talking about how we position our portfolios in the face of a significant change that is coming. And the one thing that I would tell you that you can't really refute right now is that the demand for AI continues to go up. So if you look at AI products, look at the published reports around the revenue growth rates of OpenAI and Anthropic, or what's happening with Gemini, that's a one-way train that's going significantly upwards. If you look at the demand for the infrastructure to power those AI products, that continues to go up. So we spend significant time speaking to the hyperscalers to understand what those demand signals look like. And we feel very, very confident that in today's market, we're not seeing an abatement of that demand. And so we continue to think that investing behind this AI investment boom is a good place to put capital to work. And we think that ultimately those investments are going to result in a very big AI productivity boom down the road. So yes, I think there are certainly concerns that there's a lot of building happening in the space, but at least today it seems to be backed up by a significant amount of on-the-ground demand that we're seeing to support it. So we're going to continue investing behind it.
You gave me a bit of a flavour of how you're approaching that AI, talking about the different layers that you're investing in.
Yeah.
Could I maybe just get you to talk a little bit more detail about some of the areas that you are backing in the different ecosystems that feed into it?
For sure. So let's start with the energy side, because that's, as we think about the value chain, you can't talk about AI without talking about energy.
Yeah.
And one of the interesting things that's happening in the United States right now is, as a country, we have been flat in terms of power generation for the past 20 to 25 years. Really, any increases in demand have been offset by efficiency gains. And so you haven't really had to increase the amount of capacity in the system. Well, if you look at last year, that demand was up a few percentage points, and there's many research reports that are out there that are predicting a 40% increase in the need for capacity over the next 10 years. And what that does, ultimately, is it drives a significant multi-trillion-dollar CapEx cycle that's going to be required to meet the energy needs that the U.S. Is requiring. And that's being driven by the data center build-out that we talked about. But also, the United States is in the process of reshoring manufacturing. And we, as a society globally, are electrifying everything we can, right? There's a broad trend towards that. That increases the amount of demand on the system. So when we think about investments and themes that we want to put capital behind, we like something like this because it's a secular shift in the economy, right? That's a durable thing that will continue to grow for the next 3, 5, 7 years. And yes, if you end up in a part of the economy where things maybe potentially slow down, we can debate the rate of growth, but that's not a trend that's going to start going negative on you, right? And so those are the sorts of things you want to put capital behind. So what does that look like? In infrastructure, we have our team spending time looking at utilities and transmission lines and building out power plants. So there's a physical infrastructure world that people are spending time in. And our growth teams are spending time looking at battery technology, right? Because the storage side of things has to kind of come along with this. On the private equity side, we're looking at services companies that are derivative plays around that. So, we bought a company recently that spends time on electrical maintenance testing, right? And so every time a new piece of equipment comes online, someone has to certify it and then maintain it. So the services to that ecosystem are going to continue to increase, right? So if you can identify a theme that we think is going to be long-term durable tailwinds, and then we start trying to find ways to build an ecosystem around it, that's the approach that we would take, at least on the energy side.
You've talked about secular growth themes. Can you give me a bit of a sense of the time frame or the mindset that you adopt when you're thinking about deploying capital and investing? Like, is it, you talk about quarterly meetings or whatever it is, but what sort of time frames do you think about when you're making investments?
Depends a little bit on the strategy that we're investing behind. On the private equity side of the house, we will typically underwrite an investment for a 5-year period. So we're trying to understand, what are the drivers of this investment over the next, call it 5 years. But importantly, we also try to make sure we understand what that market is going to look like for the 5 years after that. Because if we're looking to sell a company in 5 years, the next buyer is going to have to believe that the trends at that point are also attractive for them to invest behind. So we take in private equity a fairly long-term approach to what we're looking for, right? We tend to not want to make investments that are too temporal or too much of like a trade, because those are scenarios where you introduce more volatility in the outcomes that might occur. So we tend to think almost 10 years in terms of where we think the market is going to go, which is why attaching ourselves to these secular growth drivers is an easier way to think about it. But what we tend to find is our holding periods will be 3 to 7 years for an asset, right? We tend not to build an asset for sale, but if you buy a really nice business in a really good area that has good secular growth, and you're able to start transforming those companies, what we tend to find is often early in our holding periods, we'll get approached by a strategic, by another owner who really wants to own that asset for what we've done with it, and sometimes can have us actually exit a little bit early. But we do take a long-term approach to how we think about these investments.
Let's talk about where it sits in a portfolio. What are some of the benefits of having exposure to private equity, and what does it bring to a portfolio?
It's interesting when you think about our capital formation for our shareholders and our investors that have come into our funds over time. You see a couple of things. Our institutional investors, our pension plans that are invested with us, our sovereign wealth funds that invest with us, they can have 20 to 30% of their portfolios into alternatives. If we talk to the families that invest with us, endowments, they will actually have 50, 60% of their portfolios into alternative markets. And private wealth, on the other hand, is actually less than 1% penetrated. And we can touch on that in a moment. But the reason that these pensions and families and endowments have so much alternatives into their portfolios is because this asset class does provide two really strong benefits into an investor portfolio. And on the part of private equity in particular, two main benefits. One, private equity creates the ability to add complementary and diversifying risk into a portfolio. If you look globally at companies that are greater than 250 million in revenue, nearly 90% of those companies are actually in the private markets. And I always find it interesting because we as individuals like to diversify our equity portfolios, but we diversify it in 10% of the market. And so if you actually want to build a diversified global equities portfolio, you can't ignore private markets. It needs to be a portion of your investment. And then the second thing that private equity provides is, at least historically, private equity has delivered a premium return over public markets. So between the diversifying impact of this sort of risk and the potential for increased returns, that's why we've seen the institutional side of the market really adopt private equity and alternatives more broadly into their portfolios.
2 decades with Blackstone, maybe a little over. What have been the big changes that you've seen in the private equity market during your tenure?
Gosh, it's been an interesting 20, 30 years, frankly, for private equity. I'd say one of the big changes that we've seen in the market is that it's no longer this cottage industry, right? It used to be, if you went back to the 90s, private equity used to be the type of industry where you could buy a company, you could put leverage on it, and you would just make a return by paying down debt, right? It was a more simple business model. Today, you can't do that in private equity. That won't work. That's not sufficient to generate a return. Today, you have to navigate very volatile and choppy markets that are increasingly interdependent geopolitically. You have to pick the right segments of the economy that you want to invest behind. And very importantly, you have to transform your businesses, right? There has been a lot of capital formation around the sector. And in today's private equity, the winners are not the ones that can find a stable business and put a lot of leverage on it. In today's private equity, the winners are managers that can bring differentiated insights and differentiated resources to actually transform their businesses. So the really big change is that we have moved from just owners of assets to very active managers of businesses. You have to have a value creation thesis out of the gate in order to generate the returns that we've done historically.
So you've talked about the evolution of the private equity industry from being a cottage industry to a bit more sophisticated. What about how people are accessing the strategies?
That's a really, really good point, because that is also one of the big changes that has happened in the asset class over the past 20 years or so. I mean, if you look at our private wealth business today, over $300 billion of capital that's managed for individual investors in our asset classes. Historically, the majority of that capital actually used to come in through drawdown structures, right? So committed capital vehicles that allowed investors to access the asset class over time. One of the big changes that have actually occurred is the introduction of the semi-liquid or evergreen or perpetual. We seem to have a lot of names for this structure, but a different way to access the asset class that has allowing individual investors and actually, frankly, families and institutions to get access to the asset class through monthly subscriptions and periodic liquidity. And what is actually changing now is that is reducing the liquidity constraints on the asset class. And so while many individual investors, we talked about how the penetration for private wealth is less than 1%, a lot of the reason for that was because of the lack of liquidity that they have had in the asset class. For an individual, locking your money up for 10 years is a difficult thing, even if you don't necessarily need the liquidity. And these perpetual structures are allowing investors to really take a look at the asset class in a fundamentally different way and say, with some enhanced liquidity on these products, can I increase my allocation to the asset class? And so the reduction of that friction, the potential for more liquidity, is allowing individual investors to access the asset class in a way they never could before.
I imagine you put a huge amount, or Blackstone must have put a huge amount of time and effort into thinking about getting that structure right with introducing those liquidity changes for what is a liquid asset class. Could you tell me just a little bit about how it works?
Absolutely. So look, I think when you look at the industry as a whole, one of the things I think that's important for managers is actually making sure we educate the market on how this does work. Because the reality is, as you noted, private equity is an illiquid asset class. It's not meant to be turned into a purely liquid asset class. And we're very clear when we talk to investors, the industry is very clear when they're educating the financial advisor community, the wealth management community, of what these products are meant to provide and the risks that also come along with them. But most of these products tend to have the ability for investors to redeem a portion of their capital on a quarterly basis, subject to fund level caps. And those caps are in place to allow investors to get capital out, but also protect investors that aren't taking their capital out. And again, there's a lot of different rules and regulations around how that liquidity is meant to work. But the ability to actually, on a quarterly basis, get some capital out is important. I think investors, and when I spend time with the advisor community, I certainly mention this, but I view those liquidity levers really as ways to allow investors to rebalance their portfolios. Like if you're coming into the private equity asset class, you should be thinking long-term, right? You asked me the question about how I think about underwriting on a long-term basis. We're building investments for long-term. You should be investing for the long-term. But the quarterly liquidity mechanisms do allow investors to rebalance their portfolios over time.
Just a final question. You talked about the size of private markets relative to listed markets. IPOs is one way that you can realise, or return on your investment. IPO markets have been a little bit subdued. Do you have a view on how that pipeline's shaping up, or what the appetite is in that market?
The IPO markets have been subdued for several years, but we've started to see that come back in the last year. So if you look at just us for a moment, we took 4 companies public last year, just in the second half of last year. And so we are now starting to see a bid from the public markets for these assets, these private companies coming back public. As an example, in December, we took Medline, which is a medical distributor business in the US public, largest private equity IPO ever. Actually, $50 billion business went public, very well received in the markets. And I think what we are seeing from the public markets right now is important scaled businesses that provide a very important role in their ecosystems and have scarcity value. Those companies, the public markets are really, really pushing for right now. So we do believe that you're going to have a good number of potential IPOs this year. If you talk to the banks, their backlogs are at record numbers in terms of companies that want to go public. And we're starting to see good signs of an institutional and retail bid for these products. Now, we'll have to see how the equity markets go. We'll have to see how much volatility gets introduced given some of the recent events that have occurred. But if the markets hold the way they have been, I think this will be an attractive year for public offerings.
Well, on that note, sounds like a positive one to finish on. I'd like to thank you for taking the time to sit down with me today. It's been a pleasure meeting you and hearing about your view on the world of private equity. So thanks very much.
Thank you so much for having me.
Ladies and gentlemen, I hope you enjoyed that chat with Patel, who's the CEO of the Blackstone Private Equity Strategies Fund. Remember, you can check out more content just like this on our YouTube channel.